We have these two conflicting forces. If people are looking for higher yields, the issuance, the supply story might be encouraging. The amount of QE, though, taking those bonds out of the market and onto the balance sheet at the Fed, at the ECB and elsewhere, that's a huge, huge deal.
Right. No, I think that's a fair point. But the issue is supply is easier almost to get priced in. Because when you look at deficits, they're all growing significantly globally. So we can all sort of price in how much supply is going to come in. What we don't know is how many bonds are these central banks going to buy. So I think that's the tension here. I would say that our view is the net supply to the private markets actually going to decline for the developed government bond markets out there for this year as well as next year. But that's the unknown. So I think that's going to be the focus in all the Fed speak, in all of the Fed meetings, ECB meetings. And I think this is where I think action will matter more than what they say, because our view is that they're all going to say we'll do what it takes. But, how much of a rise in rates is enough? At what point do they step in? I think we're going to have to see when the market tests the Fed or the ECB. So far, I think that test hasn't happened. Now, we do get the Treasury refunding next week, so they're going to start issuing 20-year bonds. If you start seeing a big rise in rates, does the Fed sort of change its practice of the lower amount of buying that they're doing every week? Do they actually increase it one week? Our view is that they will, but this is the unknown for the market. So I think you're going to get that volatility, especially in the long end of the curve. I will highlight the front end is really stuck with forward guidance. Whether it's yield curve control, forward guidance, average inflation targeting, I think if you're looking at the 0 to 5 year part of the curve, I don't even think supply matters there. It's really the 10-year and the 30-year that we need to see how much central banks buy.
Priya, do you expect central banks to get ahead of that story? The Bank of Japan has been using yield curve control for the last several years. Is that something you expect to hear from the Fed this Wednesday, the ECB this coming Thursday?
So not just yet. Our view is that the Fed will undertake yield curve control close to year end or perhaps early next year. And the reason will be to sort of reinforce forward guidance. The market's not testing them right now, so I don't know if they need to get ahead of that. I think they keep that for particularly when the reopening. Right now the big question is how is this reopened economy going to look like? We don't have any data on that. We're still seeing the abyss right now in terms of data. I think they want to keep that in the back pocket. I do think the BOJ practice of having this JGB amount that they were going to buy along with the yield curve control, I don't think the Fed or the ECB does that. They're going to try and link or sort of, keep the front end anchored and then use QE as needed to keep the long end anchored as well. But I do think particularly with the inflation outlook, so growth we know is weak. Inflation tends to be lagging. No central bank had even reached the inflation target when we entered into this COVID crisis. So I think they're going to want to, they're going to need some tools later on, which is when we think they actually keep that yield curve control tool for now. But I think this week's meeting is all going to be about the lending programs. I mean, it's astonishing how much the Fed put out in terms of all these lending programs. Not all of them are operational. I think the Fed will want to say, look, we're working on it. They might be tweaking some of these programs. I think that's the focus right now and sort of reinforcing we'll do what it takes. But rather than sort of laying out yield curve control just yet.